All right, looks like I was on mute. Hello, everyone. How is life? How are you all doing? Good morning, good afternoon. What's going on? Let's start there. How was the week? We had a long weekend. So what did you get to do? Anything new? Anything different?
Hey guys, how's everything
Yeah,
going?
good to see you again.
I haven't been on here in a little while, so I've noticed a lot of volatility. So I'm trying to see, I guess, a few perspectives on what's going on. Maybe we can all figure it out. I was day trading SanDisk for a little while, but then I kind of gave back everything I got. So,
But
and
in day trading you get sugar rush, right? So I think you got the sugar rush, but I don't know if you can get the gains.
yeah, it was like a few hundred, and then two, 300, and then that for like a few days, and then I was like, oh no, now it's dropping. I lost like 1,000, so I was like, oh man, that kind of evened out
Yeah.
for the week. But I still had like a little bit up, so I mean, yeah, it's a big rush. I think with SanDisk, some memory. I like DRAM.
Yeah,
That's a little
RAM,
bit more
RAM
safe.
ETF. Yep. Now we have some leveraged memory ETFs also. So I'm saying, I think I did repost it today morning about Corgi. Corgi is another ETF issuer going crazy. So we'll get into that. But yeah, a lot of craziness going in the market.
And I sold some Lockheed Martin shares while they were still up at like two. Oh, I mean, something. What was it, like 450 or something like that,
Mhm.
or something? Yeah, I don't know. I got out at a decent time, but who knows when it'll go back up to that again. So that's
Yeah.
just been a slow wait. But at least I got cash on the side, and
Cool.
I'd rather have that than be too much in the market at this point, I think.
All right. Yeah. I guess everyone has to figure out. I'm not cashing out. But we'll get to see what else on the market side. Before that, let me just do a quick check. Sunita says, hi, everyone, uh, from Virginia. Glad to have you, Sunita. Anyone else joining here for the first time? Any new joinees here?
Yeah, I'm joining for the first time.
Hey, uh, how do you call your name? Osin? What?
Usheen.
Osin. Welcome, Ocean. So, what brings you here? Maybe what kind of investor you are, and where are you joining from?
Yeah, so I'm Usheen. I'm from Ireland, and I mostly would consider myself a value investor. Um, but honestly, it's all about the gains, you know. So it doesn't matter if you're in gold or silver or value or tech or whatever. It's all about what is your number at the end of the year. So I'll go in any direction as long as I can get a gain. I've made 30% every year for the last 3 years, and I'm only up about 8% this year, but hopefully we can close on a close to 30, similar to the rest of the years. I've been trying a new strategy recently of like just following insiders, like looking at what Nancy Pelosi's doing, looking at what Donald Trump is doing, just trying to if you
Hmm.
can't beat them, join them type of system. So right now, I'm trying to make some kind of a bot or something that will trigger when Pelosi trades or when Trump opens a position and try and just sort of copy the insiders. And that seems to be the best approach given this crazy market that we're in.
Yeah, I think there are many websites also which basically track what these officials are doing. Nancy Pelosi tracker, and probably there's some DJT tracker also. Yeah, yeah. If it works for you, great. Not something which I I focus on, but I guess everyone figures out what works for them, and if it's working, don't change. At the at the end of a day, I think we all are trying to figure out, okay, what works, what um, keeps us in the game. I am more of a really long-term investor trying to just stay in the game, and I think rest the market will take care of it itself. Um, my opinion is, I think we are the worst enemy of our own portfolio. If you don't do stupid mistakes, uh, others, the economy continues to grow, and we'll all do fine.
I
So,
agree. I
so
think, yeah, no, I totally agree. I think, that's what I want to do is remove the emotions from investing.
yeah,
So my ultimate goal is to build something like Medallion. I don't know if you've heard about Medallion. It's a fully automated fund, makes like 50% on average every year, and it's completely algorithmic.
yeah,
And that's kind of the goal because it takes the emotion out of it, and that's the problem is when you start to, get emotional and it can it can lead to bad results. So that's the goal is to ultimately program some kind of automated trading kind of portfolio. That would be great.
cool. Funny, yesterday I was in a social gathering, and then one of my friend, he was asking me, do you think is it worth paying, going to financial advisor or this fund or fund managers and have them manage your money and pay them 1%? Why can't we just buy, because most of them anyway underperform their own indices. Why shouldn't we just buy and hold indices or whatever the ETFs we want to? I said that's a great plan. That's what I do, but you only should do it if you can have a control on your emotions, right? The most, and if you cannot have a control on emotions, better maybe than to go to financial advisor, so that you can have a buffer between you taking an action. When the market is going crazy, you call up a financial advisor, he'll probably calm you down. If you're desperate and say, have sell my stocks at the bottom, or if you're too euphoric and want to load up your truck at the top, in that case financial advisor might help. So either have someone else if you don't have control on your emotions, or you automate it, all the investing decisions. If you're working and have 401k, your decision is already automated, or the actions is automated. Couple of, after every 2 weeks, money goes into your account, and doesn't matter where the stock is down, middle, or on the top, it just keeps building. So great to hear from Ocean.
Absolutely. Yeah, no, I totally agree with that. And I think if you look at a chart of the S&P since like 1940 or whatever, and you just look at it today, it just goes up and to the right,
Yep.
And there's all these different things, World War One, World War Two, and whatever, and like COVID, and it doesn't matter, it just continues to climb.
Cool.
And that's yeah. So I think like you say, as long as you're just even if you're investing in the S&P, you're going to beat 90% of hedge
Yep.
funds and other investors, so you can't lose really.
Sam, you have a hand up. What's up?
Yeah, I put the question in the chat. I finally, usually you know everything I throw into Gemini, so I just put it in Gemini. But how could this article say that Nvidia's, according to whatever metrics, be below 2019?
Yeah, so this is true, right? Because if you look
It is
at
true.
yeah, it is true. It's not from the price perspective, and I've not looked at your article, but I know the gist what probably this is trying to say. All it's trying to say is from Nvidia's forward PE basis, it is where it used to be in 2019, like pre-AI boom, in terms of the current pricing based on what the forward estimates, next 12-month estimates of its earnings are. And it is because the the earnings have increased at much faster pace, and the estimates of earnings have increased at much faster pace than what the price has increased. So hence your forward PE has fallen and has gone back to where it was pre-AI era. In fewer words, this means Nvidia is trading, it has not gained anything from the AI boom if you look at its forward multiple valuation, right? So and some consider it as a part of maybe Nvidia is undervalued because a lot of attention and the capital has flown to the next shiny objects, which is memory stocks, optoelectronics, pick up Caterpillar, and that's what they're referring to. And if you look at maybe Nvidia forward PE, I wouldn't be surprised that it's, let me just look at what the number is. So if I'm looking at NVIDIA forward PE, it is sitting at, yeah, okay, stock analysis says it's 20, right? 21, which is cheaper than where the index is. So yeah, like depend, some website might show it at 18, that's fine, but I think the gist is that it is cheaper than where it used to be earlier. All right, we got 20 people. Some others might join a little later. So shall we get started? Or is there anything else on you guys' mind? Any other specific questions? Radhi, you say NVIDIA's trailing peg is 0.6. Yeah. Okay. Yeah, so it does seem cheap. And sometimes I think some commentators are saying it is also kind of a fatigue because NVIDIA is so big that some investors think, how, how can it get bigger? And a lot of people have already sitting on a lot of gains from NVIDIA, and now they're of opinion, maybe we find something else which have been recently going up, and a lot of cash or money has moved into those next shiny objects. All right, so what I want to talk
Excuse
about
me.
today. Yeah,
Vivek, can I add something else?
sure.
So I was listening to Adam Khoo in Singapore.
Mm-hmm.
So he was saying that when Nvidia went up 3 times, he thought, "Wow, gotta get out." And now it's gone up 10 times. What are you supposed to think? So you think everybody's kind of like the guy said, fatigue.
So I didn't get you. I mean, Adam.
No, they don't know. This guy is justifying to go up further because actually, in 2022 or 23, sorry, the guy that used to belong to Google? He said Nvidia has like 3 years. They're and they still have stockpiles. So it's just this guy is trying to justify reason for Nvidia to go up for another 5 years.
Yeah, so again, like Rajiv mentioned, NVIDIA is very cheap, and also it's a great business. If you look at the business quality of NVIDIA, I mean, it is one of the best businesses from a qualitative perspective that I hold in my portfolio, right? So, and it's not expensive, but right now, I think a lot of great businesses, a lot of managers, like fund managers, have made a lot of money on all these Mac 7s and NVIDIAs over the last 2 years. Now they're trying to find a new shiny object, right? So, Carl, so no one with 88% margins will not come under attack. Yeah, Google and Amazon custom silicon. That is true. A lot of, and that's where we are seeing a growth on the Broadcom is, I think their customers cannot sit on the sidelines and have NVIDIA enjoy 45% net profit margins. But it's not just this year. Even if I look at NVIDIA's financials over past many years, I mean, they're still a great business. So I just added, if I'm looking at the currently scores 9.7 on my framework, looking at 2025, if I go back into time machine and go to pre-AI era, right? And then I look at the numbers, still not bad, 8.4. And even then, you're still looking at 36% net profit margins. Not as great as what it is right now, but come on, I'm even talking about a pre-AI era. So somehow NVIDIA knows how to go through various cycles. Right now, since 2023, they've been enjoying the tailwinds on AI, but in absence of that tailwinds, it's been a decent business too. That's what I meant to say. And at the valuation where it is trading right now, it's pretty cheap. But now the market momentum is not behind, has not been behind Nvidia over, let's say, last 6 months or year to date, and we don't know when that tide will turn. Eventually, if we see weakness in the market, the money will flow into the companies that generate decent amount of cash and are good businesses with a decent margins. Right? As long as markets stay euphoric, you try to play your bets on something which is always been going up. The momentum works then, which is right now, and that's what working right now. It's momentum. I do want to bring up another fund manager, that I followed for many years, and that fund manager caved in this week. Let me guess. Can anyone guess which fund manager am I talking about? It was also on, I could see a lot of posts on Twitter around that. There's a fund manager who finally caved in. Very value-oriented fund manager, now trying to become a momentum-based. So yesterday I was reading, it's a semi-annual letter to the fund holders. And yeah, we'll talk about that. Sometimes to me, it feels maybe that's a kind of is that a sign of a peak?
Yeah, I think that's a bad signal for me.
Right? Where the last holder, okay, guys, I need to get into this now.
When he has got a mandate to stick with value stocks, and if he's felt so much pressure that he's calling it quits, that means it's like a peak. Or
So
what it means is essentially we are in a crowded trade where almost everybody who should have bought has
already got in.
Yeah.
Who is the next marginal buyer?
Exactly.
If that Mr. X is now also got in, who is the next buyer from?
Anyway. So that's my answer to like Sam Liu. Like basically, in the last 18 months, pretty much we have gotten everybody who could have gotten into AI trade. And now I think it's going to stabilize. It's going to digest its gains. But the investment class still remains valid. That's all.
Anyway, so we'll look into that. I think I do have a topic that I want to talk about. But all right, maybe we'll get started now. Let me just see if there is anyone else who is joining here for the first time, and then maybe we can get through the intro. Hello, this is a person named Hello. Right? Is this your first time? Because I don't recall seeing this name before. Hello.
Hey Vivek, this is Chayan. Just had my default
Okay,
name there.
okay. All right, Chayan. Good.
How are
Good
you?
to have you back.
Yeah, I know I've been absent for a while.
Yeah. All right. I guess all other are regulars. All right, so let's get started. All right. Good morning, good afternoon, everyone. Welcome to our Saturday discussions around everything around investing as a DIY investor. Topic that I want to talk today is, of course, we'll look at a macro, but I also want to talk about a couple of IPOs that have happened recently. We'll give you an overview of that. If you're interested in doing a deep dive on it, let me know, then I can do a deeper dive into the S1 document, maybe in subsequent sessions. But today I just want to give an overview. Another big topic I want to cover today is OpenAI. And is that sitting on a melting, ice cube or iceberg? Want to bring up some numbers and some thoughts around that. I did, yesterday I was listening into an interview by a journalist / author, and he does make a very compelling points. So I thought maybe I'll come and share and talk about it. You guys can decide what you want to do based on this information. My job is to at least bring forth the information which could help you in your own investing thesis. Also want to talk about that fund manager, and hey, is this a sign of a peak? There are at least two things that I noticed this week, which, and again, two things is not a big statistics, but there could be many more things happening which I'm not aware of. But I do want to talk about those two things. And Yeah, I'll go through some company news and what impacted their stock prices, etc. And that's it. And we'll open up for discussions in the breakout rooms, and then we can talk about anything else that you guys are interested in. Cool. Any other topic you want to add? All right, so let's get started. As always, anything that we discuss here is only for education or maybe entertainment, but please don't go and trade based solely on what you heard, right? My humble request, never copy anyone, not me, not anyone you hear on YouTube or any other channel or any podcast. Over the years, I've seen even the established fund managers, they will say something else, but they will do something else. You'll never know what their motives are. So build your own strategy, figure out what you need to do to meet your financial goals, and then you don't have to copy with anyone else, right? You don't have to follow anyone else in terms of I need to beat this guy, or I need to beat S&P 500, or I need to match returns of my neighbor or my friends. That's an absolute BS. I just don't subscribe to that philosophy. I used to think that maybe I should beat S&P 500, but now my objective is different. My objective is to make sure I have bills to pay and I can pay all those bills in time. If that means some year I don't have to beat, great, right? So figure out what your own game is and play your own game. You will never succeed in playing in someone else's game. That's my humble request. So don't go and trade based on what I do. Figure out if it works for you or not, right? And it might take some time to figure out, but that's okay. When we're talking about investing horizon, we're talking about 20, 30, 40 years, right? Andres said, don't sell stocks for losses just to pay rent. That's what I want to try to avoid, right? Hey, let's build up a cash in that in case if the market corrects, I don't want to sell my stocks at a losses. Probably sell it when it's an all-time high, because then it's been the best. So far that would have been the best time to sell it. Anyway, so quickly looking at the indices over last 1 month. 1 month is nothing, but hey, all indices have been positive over the past month. The best performance has been with DIA, which is Dow Jones Industrial Average. This does tell us a little bit of, and we talked about it last week also, shift from a little bit more shift into the value and non-tech sectors also. SCHD has been a great performer. Again, more of a financials, healthcare, those sectors. So, and Dow Jones has got a lot of those companies. And so that's been the best performer. Next best is SPY, and then IWM. Surprised with the growth that IWM has this year. That's amazing, right? But overall, this is not a good picture. Last year I was happy that it was in the red zone. By the time, maybe next week, I'll flip the red to the greens, because now the green zone is actually not a green zone for us as an investor, right? We should be fearful when the fear and greed index is actually in a greed zone, right? So greed is not green, it should be red. So next week I'll basically flip the colors, but this is how I think many websites show that they feel that when the rest of the market is fearful, it's a bad thing. No, that's a great thing. I would rather have more time in the market, are fearful, so that I can build my whole positions in the stocks that I love before the market push those stocks to stratospheric valuation where I don't want to touch them. But right now we're in a neutral zone. Last week we were in the fear zone, and now we come back to neutral when it's again, I just use this as a contrarian indicator for myself. When the market is in a greed zone, I want to make sure I don't go too high on deltas on my portfolio. I don't do too many bullish trades. I want to take it slow, maybe go and touch the grass, walk in the sun, read some book, but don't give into FOMO, especially when these indexes are going on greed. And we've been there, have seen this story earlier also. for me, it works better as a contrarian indicator. So if it flips to greed, I'll probably start closing my bullish positions and then just wait and watch. What else? Sector wise, energy has been again, the energy has been flip flopping from better to the worst. Isn't that funny? In 1 week, it's the worst performing sector. In another week, now it's the best performing sector. And like it or not, this has been based on what comes out of our president's mouth, or maybe not mouth, probably what he posted on his Truth Social. And now I'm having fatigue of this whole war stuff, right? Don't care. I don't think even markets also don't care much in terms of what where the war situation is. Like, we have won, if we believe administration, we have won the war 50 times already, and then we are still talking for peace negotiation. I don't know what's truth. In any way, right? Energy stocks were up 3%. The worst performing were industrial and materials. Looking at little longer duration, year to date, S&P is up like almost 10.6%. I think this is including dividends. So not a bad deal. We are, what, 6 months into this? And we are up 10%. What more can we ask for? We've already had the average gains over the last 100 years in 6 months. Ocean is like, why is all so low with the war carries on? Has a market priced in peace? So we'll talk about it. I think the next I talk in a macro overview, we'll look at some of the stat which says the market is now doesn't care much. The impact of the oil price change on the market over the past many weeks, it start to have a lower and lower impact, because market is now absorbed the earlier shocks, and it's like, yeah, eventually we'll get it done. This thing is just keep coming out of administration, and eventually we will get peace. So the magnitude of movement in S&P has reduced based on the oil pricing. But I saw, looking at some companies, and first of all, Dow Jones crossed 53,000 for the first time. It's not a long time ago that we were in the same meeting and we talked, Dow Jones was above like 50K. Right? And now it was somewhere this year, right? So, and now it's like 53,000. So not an index that I focus on, because from my opinion, this is a BS index. I just don't know why the rest of the world and the financial media paid so much attention to it. But this is the best known index outside of a US, where when they want to look at US as a stock market, outside US, everyone talks about Dow Jones. Right? Not S&P 500 is not that popular, because this has been the longest surviving index. So even though it's not, I don't consider it as a representative of the overall economy, but hey, it's been there, and so media still talks about it. So it hit 53,000 for the first time. Some companies, SK Hynix, I think there was a question on, did anyone get an allocation or bought SK Hynix? I don't want to buy at the price at which it is trading. I have not looked at in terms of how good this business is. If I look at a Micron, I don't find that Micron over the past many years as that great a business in terms of the margin profile. Right now, they have a pricing power, because where else will go? Right? There are no chips to have. And I think the Samsung came up with the news that they're going to increase their capacity. There are a handful of these suppliers which make high bandwidth memories. Samsung, SK Hynix, Micron, and all these companies have been enjoying, the stock prices have been enjoying stratospheric gains over past few months. But longer term, from a from a margin perspective, not that great. Maybe future could be different. Who knows? But we'll see. So SK Hynix eventually also listed. So it's already trades on Kospi, South Korean exchange, but it also did its debut on Nasdaq. And why not? When there is so much demand of AI related stocks in the capital market where the most of the money of the world flows in, why not come and list your stock and raise some great money, right? So they did a raise of, I think, $26 billion. This is the highest dollar amount raised by any foreign company in US markets, right? So it is the biggest one, and I think after it opened at 175 or something, right? It's closed at now 168. So it's already surged 12%, 13%. This is despite the fact that they listed, the list IPO price was a few percent higher than where it trades on Korean exchange. So those who've been on a crypto market for some time probably know of a kimchi premium, i.e. the traders and the investors in South Korea, they are willing to pay higher prices for the cryptos or the stocks that trade in Korean exchanges. And now this one is like a reverse kimchi premium. We are willing to pay much higher price for SK Hynix as compared to the investors who are paying for the same company in Korean exchange. So now we have a reverse kimchi premium. I've not looked into SK Hynix yet, so I don't know, the margins, etc. But personally, I think for me, I'm not gonna get into any one of these companies, any individual companies. If I am basically doing short put on DRAM so that I can get a wider exposure across many of such companies, including Samsung, SK Hynix, Micron, etc. Right? Not That's not going to be a big position of my portfolio because I personally feel all these businesses are not as great from long term as what the valuation currently is. But then yeah, it's always okay if you want to gamble with small amount of money, sure. So portfolio sizing is important. What other, let me go through some comments. I see a few comments. Oil, I think I've already addressed. Sam says about Google. Andre, I'm waiting for a pullback. S&D cam loading on 1718, more on 1700 something. Yeah, if your thesis say that's a great buy, sure. What's the analysis of SNDK? Doesn't score too well, but again, every investment thesis is two parts, right? When you go back, see how they've demonstrated throughout their life in terms of their financial profile, margins, etc. And the second portion of investment thesis will be how about future, right? Because if you're investing today, you need to know both things, that the future is going to be great, and then the company knows how to encash in on that future. That you can only tell by looking at how well they have done in the past. So looking at the past, I don't feel that SNDK is a great business to invest in, but you might have your version of a future which is much more rosier than mine is. In that case, you might feel, oh, I think SNDK, probably you still may want to go ahead and invest in SNDK. Right? Like Rajiv mentioned, its forward PE is 9. It means the analysts currently are expecting huge growth from SNDK in next 12 months, and which then makes the current pricing look cheaper than the market. But yeah, if you agree to it, yes, it is cheaper. Looking at the past, not such as a great business though. So I can let me just, did I already pull up? Okay, let's pull up SNDK. SNDK. Okay, it's getting the financial data. So we'll look into that. I think same is the case with like Micron. So SNDK, from a moat or profitability perspective, pretty bad. Because and this is because of their margin. Okay, so SNDK, I don't even have a large amount of data, so I shouldn't be commenting more on it because this got spun out, and it's not a great margin business. It's a solid balance sheet, but when it comes to margin profile of that business, not that great. Maybe 2026, the picture might flip because it's gonna get an extremely high revenue growth, right? 2024, it had only 10%. Maybe 2020, last one in 2026, probably this will flip the picture. But anyway, not much of a history. But if you want to look at a similar other company, if you look at a Micron, compare these companies and their margin profile with some other companies like NVIDIA's of the world. I mean, even if you compare between the NVIDIA and the AMD, the picture is very clear in terms of which is a better business between AMD and NVIDIA. I'm not talking about the pricing, right? The price increases could have been depending on what the investors are willing to pay. I can only look at which is a better business, right? So not that great. So MU, which is Micron, right, have been around for long. Return on invested capital, 12%. And this has improved over last 1 year because of a lot of a demand of HBMs. Overall margin profile, look at it. It's been single digits to mid-teens, right? Not that great.
Again, for Micron and SanDisk, the story is in what they're projecting for the next 4 quarters. It's like the revenues will be 20-fold. Just imagine.
Yeah.
That's
Now,
where the.
so the question, so let's talk about that. I think, do I have that? No. So what happened with Samsung? I think I probably have that. Where did I have it? I think it's in the macro, we'll talk about it. Those projections, again, the question is, has the stock already accounted for and has run up over the last, whatever, a year? It's up like 600% or whatever, 100%, assuming that, hey, this feature is going to be great. Look at what happened with Samsung. Samsung announced its results. Their net profit was 19 times
Right.
as compared to last year. Not 19%, 19x. And the stock still fell down. So two things. One is you need to, the analyst projections of the future need to come true. Second hurdle is investors' expectations of the what's currently priced in has to be less than what the analyst expectations are, right? And
So on that, I've noticed. Did you notice when Broadcom announced results in end of May, the same thing happened. Like after it announced results, the price of a Broadcom Avgo went down dramatically. So what I've noticed is in the last 3 months, essentially the phenomenon is that earnings are sold into, or stock are being sold into earnings. But like in the quarter of October to December of last year, it was the other way around. So take it for what
Yeah.
you know.
So it is very difficult to know how the stock price will react. Even, we don't know what's priced in. It's all about the expectations game. We all know what company has done or company's projecting is going to do that much of a revenue. But what we do not know, and no one knows, it's what market is pricing in already. We will only get to know post the reaction of a market saying, you up like 19 times, who cares? We still sell off your stock. So I want to focus. Yeah, sure, I will take some bets, smaller amount of bets on these high flyers. But over the years, I figured out that if I want to own a businesses that have been great businesses over many, many years, and these tailwinds will come and go, right? If you're only looking at for next 1 year or 2 year, sure, look, I could load up on this, but I want to build my portfolio, which will survive for next 10, 15, 20, 30 years. And me personally, not want to keep jumping the ships from which is the next hottest one. I want to have a better things to do in life. So yeah, so I open position on DRAM, but I don't want to have anything on these individual stocks. So
Did you buy DRAM?
no, I have a short put on DRAM.
Oh, sure. Okay. So my view is like just buy the stocks or any semi index because it definitely is going to steadily grind higher, even if maybe SanDisk might dip or Micron might
No,
dip.
so the reason I don't buy socks is because socks has got a lot of these TSM, ASML. These are
Right.
again semiconductor AI related companies, but I hold individual stocks of these companies because these are great businesses, right? If you look at, so both of them will be reporting results
Right. So they
this week.
have
Yeah,
some overlap, yeah, but it's a good way for average investor to get exposure. That's what I.
correct. So there are SOX is there, SMH is there, and if you do not have any semiconductor exposure, look into those holdings. Yeah, they're pretty fine. What I don't have is any of these memory stuff. So I looked at DRAM, that all the top holdings on the DRAM, etc. Many of those I don't hold. I don't have SK Hynix or Samsung's or what do you call Micron in my portfolio. Look at TSM. This is a fab company and still great margins. The margins are like software like margins, looking at 45%, 40% operating margins. Like, not just for 1 year, 3 years since the AI boom. Last 15-year average. Look at his still 35%, but these are like software like margin. That's why I hold this company individually in portfolio. I don't think I want to own, let's say, MU. And same is the case with ASML. ASML stock price, I mean, this year it has done great. Last year didn't do that great, but it's a good business to own for a longer period of time. I've owned ASML since 2020 or 2019, like $350 stock. And I've gone through a lot of ups and downs with it, but yeah, it's a different quality of business. Same space, different margin profile, much better business to own as compared to some of the others. Like this is like NVIDIA like margins. Right? Looking at return on invested capital of 30%, profit margins of all close to 30%, decent growth, right? So yeah, I do want to own some of these great businesses. I don't think I can say the same thing about some of the other high flyer stocks. Broadcom also scores up well on some of these parameters. All right, Meta platforms. So Meta was a standout winner for this week. The stock is up close to 17%. I did tweet a bit about Meta. Again, Zuckerberg did post, I think after a hiatus of 2 years or maybe 3 years, he posted back on X. He came back on X because X is a competitor of Meta Threads. So, but he came back on X to announce release of the coding tool and image generation tool. So that's what the second announcement that Meta had done. Last week, earlier of previous earnings release, he talked about that if we have a spare capacity, we will be willing to lend it out to others. And last week, it made it as like a officially announcement, and they have hired leadership to have Meta go into basically renting the compute capacity. So we did talk about that. Is it directly competition with hyperscalers? Now they talked about releasing the coding and image generation foundation models, which means we're now getting into space where Anthropic, Google, and OpenAI are. And latest news was also this week was building its own AI chip, right? So diversifying it, take it, based on your own thesis of Meta, take it how you want to, but the market really liked it. That, hey, it's going to diversify its various revenue streams. You can have a bearish thesis based on this also. Say, hey, you overbuild the capacity and you have not been able to use it, which you told us that if you've not been able to use the capacity, then you'll rent it out to others, which is what Meta doing. But market liked it. Stock is up like 17% in 2 days. Having said that, it is still way below its high that we had somewhere last year, right? So going back to Meta.
The Meta is doing the right things for the 3-year horizon, so that's why the stock is going up.
Yep. So looking at, was it? So I think its highest all-time high was close to 800, 796. And I just closed just above, close to 670. So still well below its all-time high. And not just a case with Meta. I think apart from Alphabet, all other Mac 7s have been lag 7. I haven't done much this year. In fact, many of these Mac 7s have been dragging down S&P 500. So, but that is a significant news on Meta. Broadcom news was that Apple, they signed an agreement with Apple to supply their custom chips till 2031, which is expected to be close to $30 billion worth of revenue from Apple. Right? I don't own Broadcom, but that's something that I could put on my watch list. Seems to be a good business. Microsoft was in the news, restructuring from their gaming division. Looks like their whole Activision acquisition hasn't worked that great as what they thought it to be. So then laying off close to 5,000 employees within their Xbox gaming division. And this news plus rising AI costs and all that. So Microsoft hasn't performed. In fact, it was, if I recall correctly, it was down. It was already in a bearish territory for year to date, right? Yeah, year to date now close to 19% year to date. Yeah, last week it was bearish territory. It's been dragging down the whole index. Could be a value play. Don't know. I am not, given his old relationship with Open, and you guys can tell me what you think about it, right? If you look into this seems to be the cheapest it's been ever been based on some of the valuation metrics. But I don't know. I'm not real keen on trying to go to add too many deltas on Microsoft. I'm a little concerned about this whole OpenAI and the risk that Microsoft has because of its dependence on OpenAI. What do you guys think?
Yeah, I guess I haven't been seeing use of OpenAI in my own kind of professional world as of the last several months. I think OpenAI had the, kind of sound waves all through 2024, 2025, but we haven't heard much of people clamoring, oh, OpenAI did this for me.
I don't know. I mean, I just want the dust to settle on this whole. And I know Microsoft is trying to de-risk from OpenAI. They also are now, I think they did make a news saying they're gonna also allow open source models, Chinese open source models available on their Azure, etc. But I'm a little concerned because they have a lot of stake on OpenAI. So I did sell first I did sell a short put spread, but then I say, okay, I converted into iron condor. Maybe I'll continue to sell a premium with a defined risk and wait for clarity to appear. That's all I can do. Not feeling too bullish right now until I get a little more clarity on the whole OpenAI stuff. Apple sued OpenAI for trade secret theft. Like looks like some of the employees, ex-employees of Apple, they went to OpenAI and then talked about, uh, told their friend how easy it was to get some of the documents out from Apple. Looks like there was some bug that they discovered in authentication of Apple internal control systems, and they were still able to access, even after quitting Apple, they were able to access some files and all that. And they went and bragged to some other colleagues. Apple is suing those employees at probably OpenAI for the trade secret theft. That's going to be fun to watch. I don't know how big. I've not gone into too much of a detail of that one. I think I read a post about one gentleman who basically took away all the drawings and the schemas, etc., related to a device that Apple has been working on. Rivian. Not the first time, won't be the last time, but did another stock offering, and the stock fell down now 19%. Right. I know some of you asked about Rivian last year. We haven't talked about Rivian for quite some time. But again, I still maintain the same position. I know a lot of investors got into Rivian because it's going to be next Tesla. Sure, it could be, who knows? But I want it to start breathing on its own. These companies, Rivian or Lucid, they're still on ventilator. And if they're on ventilator and if the markets are, the ventilator, the plug will be pulled and then they'll die. And I want them to start breathing on their own before I would consider, parting away with my dollars. So even though, they had a better than expected production numbers, but the fact that they just have to continuously raise capital, either through debt, which is done a few times, or by doing a capital offering and a stock offering and dilute the existing shareholders. So they did a $1.5 billion stock offering and the stock is down 19%. I'm not surprised. I mean, this is what will happen. So unless you start generating enough operating cash to survive on your own, what else are you going to do? There are only two ways, right? Either you raise debt or you sell stock. Both cases, not that great, especially I think Rivian already has a lot of a debt. So, and if it survives through this whole capital investment cycle and come out great, there will be better. Yeah, there will be times when I can, own later also. Another company in the news was Circle. Circle was up 14% because they got approval from OCC, which is the bank regulator, to establish a national trust bank. So Circle is a big player in the crypto economy, is an issuer of a stable coin, a USDC, and now they got an approval to become a trust bank. So now we come full circle, right? Unintended. They try to disintermediate, get away from banks. You can't trust banks. So that's why we moved to crypto, and now we're back to becoming a bank.
And from a stock point of view, I'm looking at the chart. One should short these things when they come public. It came public around $270. Now it's at $66. So I think this is just a short covering over the last one day. Just like I got into a small short position on SpaceX. These things are designed to drain unsuspecting people from their wealth.
Oh, yeah. IPOs are the worst time for a retail investor to actually buy the stock.
Some IPOs for sure, yeah.
Collectively, people have lost money if you have bought it on the day of IPO.
Yeah, let's look at in your stool, can you look at financial of Circle? Like how much losses it's making?
No, but yeah, so the Circle is more of a financial company, and I don't know if the same parameter applies to these companies.
Price to book can be used for.
Yeah, because financial companies should be valued in a different way, right? Mostly on the book price to book ratio. So that traditionally,
It's still making profit. It has.
oh yeah, from the numbers perspective, uh, profit margins are all negative.
Earnings, no earnings growth, revenue growing 20%. I don't know why somebody would buy this stock.
Yeah. Only thing that's coming is the revenue growth. And again, I think if you really want to invest in them, maybe pick Coinbase because they make more money on USDC than what the Circle makes as a issuer. So the distribution channel, which is Coinbase, they make more money on distributing USDC than what the Circle makes.
So what is your prospect on coin? Is it a good time to buy?
I've not looked at Coin, and I don't. I mean, if you want, if you are bullish on the crypto economy side, only then you touch these stocks, right? Or the other way is if you want to play in the directly into these crypto coins / ETFs. Now you don't really have to buy the crypto digital asset. You can just buy the ETFs. These are the two ways to play. Either you play in the companies that deal in this asset class or directly buy those assets. Right?
How about IREN?
Iron
IREN.
has become an AI company, right? So they pivoted from being a miner to an AI company.
Yeah, so I mean, essentially they're doing using their mining capabilities to provide AI.
Crypto has been in a winter, right? So for after peaking last year,
Right.
it's been in a drawdown. So a lot of players have moved from being a miner to basically use the same mining rig to provide compute capacity. Right? So Iron moved over there. I think CoreWeave also came from that. Was it CoreWeave? If I recall, I think CoreWeave also came through that. There used to be a Bitcoin or Ethereum miner, and then they say, okay, we're going to use this capacity to run the AI workloads, right? Micro strategy. So the idea, if we want to do on a coin, there is an additional layer of a company specific risk or opportunity that you're adding in. If you're comfortable with that, fine. I have like Bitcoin and Ethereum ETF, maybe Solana ETF I want to buy. There are so many ETFs available. If you want to play in that asset class, it's like buying gold or GLE ETF versus buying GDX or GDXJ miners, right? I would, if I'm bullish on gold, I personally might just want to have a GLD exposure. Not saying that I've never played GDX. Probably I've done GDX also, but yeah. So that's I've not looked at coin, but its futures are tied to how the crypto market works, and that's not been a great, right? Most of their revenue is based on the transaction. Not a great story. Wow, 159, and it was like wow 440. Just right across a year ago.
I covered my short on coin a couple of weeks ago.
And 440, now it's back to 160.
I think all this Bitcoin and everybody, they'll keep going down over the next decade. This
That I
market.
don't know. Too difficult to predict. WDFC, WD-40 company. What I mean, I'm surprised on this company with the ubiquitous WD-40 lubricant like was up 12%. I never looked at this company. I don't know how good or bad the business is. Might want to just go and look at what's the ticker? Anyone owns this? WDFC. Let's see what shows up.
It's probably in specialty chemicals, which have been doing great
of late.
What's driving this? That's what I'm not sure. Anyway, we'll come back to it. And lastly, around clarity. So we saw some positivity on the Bitcoin and on the overall crypto ecosystem, despite the fact that the biggest buyer has now become a seller. MicroStrategy sold a bunch of Bitcoins, not the after selling the initial token 32 Bitcoins. I think this week they sold 30 some 3,000 or some huge number of Bitcoins to raise cash so that they can continue to pay dividends to their preferred shareholders. Market took it in its stride. And this is a healthy scenario I would consider, that when the biggest buyer has turned a seller, after initial hiccup, mark will like, yeah, that's fine. We'll find another buyers in the ecosystem, which could be institutional one. And if Michael Saylor is not going to buy anymore, it's okay. I think the other reason is we saw some little more advances on the Clarity Act. And if this get passed, that's going to be bullish for overall crypto system. The final one is around Sony. So I never knew that the electronics giant Sony had a big financial arm until I saw this news where I was looking to, okay, there's another one which got a approval from OCC to become a trust bank. And that's a Sony company. The financial arm of the Sony company, they'll create a bank called Connectica Trust, right? And the reason why they want to do it, they want to basically get into the stable coins. And based on the Genius Act, there are some limitations or the regulations that the stablecoin issuers have to follow. And having a charter as a bank, if you are a bank itself, it becomes much easier to do the business. And that's why I think the Circle wanted to become a bank. And now the Sony also had applied and have been granted license. So it's a little more positive news around the crypto side. Okay, so WD-40. Let's look at from a wow. That's a good business. Decent profit margins, mid-teens profit margins, not too high, but look at return on invested capital. They're able to, whatever the money they invest in, have been able to get a decent return on it. Not either the operating cash flow has gone through the roof or the capex has just cut down. I don't know why over the last 3 years the capex to operating cash flow has become so low. Did they divest something? That's one I figure. But overall, it looks not.
They raised full year profit forecast to like a very big number.
Yeah, but it's an expensive stock, right?
And a buyback program. See, that always.
600 million revenue and 103 billion, or like net income of 90 million. Decent free cash flows. Debt to equity 0.36, decent interest coverage. We're pricing in 18% growth in free cash flow. So, and but to me, it looks to be expensive.
So,
5-year estimate of EPS growth is 10%, and currently we are pricing in 18% growth in free cash flow for the current valuation, which seems to be on a higher side to me. So, yep, to me, it looks to be expensive from valuation perspective. But from a business side, right? If it becomes cheaper, the way I use this is, hey, if it is this is a good business, maybe add to a watch list, and if it becomes cheaper, then maybe I will be willing to open up a position. Business wise looks okay, not bad. Okay, learn something new about WDFC. All right, how are we doing with respect to time? 11 o'clock. Maybe I'll do just give you overview of just one IPO. SK Hynix is all over the news, so you probably have already heard about that. I'll skip that. Bending spoons without touching Google or any of the AI tools. How many have you heard about bending spoons? AOL. Everyone, I'm assuming everyone knows, I've heard about the name AOL. How couldn't we, right? We grew up in the internet economy, right? AOL is back in IPO. So Bending Spoons is a company, and while I was reading through it today, I realized, wow, it owns a lot of these brands that we gave up for dead. You know, it owns AOL, it owns Evernote. So looks to me, it looks like basically this is like a constellation software of the Canadian company, which just keeps buying the software companies. The same thing Bending Spoon does is it keeps on buying a lot of these software companies, which either are given up for dead or market has soured on those, and basically improve their operations. And I was just still reading through the detailed S1 review. I only got through 7 or 8 pages today morning, but seems to be an interesting business. I don't own any of these, consolidator companies. There are a few. Constellation Software has done great for investors, bar, I would say, last 1 year. And I'm like, wow, that looks interesting. Yes, it owns Meetup as well. Yes, it does own Meetup. So they raised money. They raised $1.68 billion. IPO price was 29. And first day it was up like 40%, not as fallen back. So a quick history. It's not a very old business. Started in 2013 by 4 friends. Initially, they seeded like 40,000 from the previous startup. And they were largely bootstrapped, self-financed by reinvesting profits, raised first major external rounding in 2022, which is like, what, 4 years ago, and then 155, another 2024, and the valuation with $2.5 billion, and October 2025 round at a valuation of $11 billion. Now they went live at what valuation? Maybe we'll have to see. So basically this acquires, transforms, and operates a portfolio of digital businesses, right? So that's why it's all on acquisition spree. Now, some of the prominent brands that it hold: AOL, Evernote, Vimeo. Vimeo is basically your video sharing. A lot of businesses use it. Eventbrite, right? Where you can go and buy and have tickets, etc. for events. It use that also. WeTransfer is for transferring huge files, right? Which is like if you have a 4 GB of a file, you could use WeTransfer. I don't know what StreamYard is, Remini is, etc., etc. But seems to be a company which buys the assets which the rest of the market has given up for dead, and then clean up the operations and make them profitable. Now I know why the heck they raised the whole meetup price for me. I'm like, dude, what the heck? For this doing this meetup group, I think it was last year or 2 years ago, I suddenly saw a jump on the bill every 6 months. Now I know, because it's damn, the Bending Spoon is trying to make money out of meetup.
Every time you click on a web page on Meetup, it tries to put you into a plan. Like, I want to see who are the users who are going to be attending the Meetup, and it wants you to join the plan.
So the founders have 83%. of control. So if you want to own these shares, make sure you're comfortable with those founders. Um, look like one of the CEO, he worked as a consultant at McKinsey and co-founded an earlier unsuccessful startup called Evertail with the same team. Major investors, Bailey Gifford, pre-IPO shareholders. I admire Bailey Gifford, so I need to go and maybe see what their investment thesis is. Cox Investment, I don't know which one is this. I've never followed Cox. Galileo, have no idea. But these are some of their major investors. Like, I was surprised to see in terms of the lot of companies or the brands or the products that I've used. I'm like, oh, it's also owned by Bending Spoon. This is also owned by Bending Spoon. So I think maybe you search in a financial media, they'll say AOL is back in the public markets, of course, in a different form now. Now it's in the Bending Spoons. How the stock did BSPL BSP. Okay, this is why you shouldn't buy on the IPO day. It was
So
up like
I have to say this. One kind of like very sure signal, at least to me, which I've seen as a negative for recent IPOs in the Silicon Valley for decades, is the percent ownership by insiders. Can you tell me if it is high, like 20% or above, it's a good thing or is it a bad thing? I think it's a bad thing. Essentially, this stock is not gonna do very well long term. That's my
no, no other way around. If you look at it, like Facebook, some companies, some investor consider it's a good thing because it becomes a key man risk, right?
when Facebook went public, do you think its ownership, inside ownership was showing 20% or more? No, it was not. So
So
that
doesn't matter inside or outside. Eventually, it's the who has a voting control, right? You can't replace Mark Zuckerberg, even if the Mark Zuckerberg only have 5%, but probably own a different class of shares and have the much bigger voting power on it, right? Same case with the Google. This is the model which Google had, um, you know,
right, it's in the terms of class of shares, but I guess in a way, what I've noticed is when small firms go public in Silicon Valley, if the insider ownership is 20% or more, they're kind of totally manipulated to bring the thing public, and then the insider slowly cashes out. Like I was with a company called coupons.com, which became Quotient. The same damn thing happened. These things are to be not trusted until they come down to a insider ownership of say showing 1% with a corporate governance, which is world class and so on. Anyway, that's my two
no,
cents.
I think there's a different opinion. A lot of investors, they would like to have a higher insider ownership because then it's a, hey,
Oh,
you're sailing in the same boat as the
I know
other investors.
that's a mistake in my opinion.
Yeah. Now, I've seen some investors actually giving a higher rank because then, hey, you are, if the stock goes down, you're also getting impacted. So I would rather have a CEO which has got a much higher ownership because he's going down under with me, right?
Oh,
So at least he'll try to save himself.
so this owner of coupons.com, he brought it public in 2014. I was part of, I mean, I was not when it going public, but he slowly kind of very deftly got rid of the stock that he owned all kinds of ways, man.
Yeah, so you have to make sure that
Bust
it's
after 2
liquid
years.
enough, right? So
Company went bust. So these are unethical, unprofessional, kind of owners who think, oh, they've worked on this company for 18 years. It's their right to kind of take away $500 million out without others noticing. They are
yeah,
not there to kind of like be like Elon Musk, believe me.
yeah, we always have those characters. All right, quick look on the Chintan says should invest in the products we use. Switch to Luma. Yeah, I've seen Luma. I'm seeing a lot more invites through Luma. But again, I'm wondering is, hey, some part of time they'll also start charging, right? And the problem that becomes when you have a network is now we have to move everyone else should also be on Luma. And that's what the network mode is. Right? If it doesn't matter if I move, you all all of you guys also have to now move to Luma to get to and that's I would say a barrier for me to switch. But anyway, I hope they don't make it as like too high for me to know that, come on, guys, I'm giving it up. So oil prices were still higher this week, but way below March peak. This is what I wanted to talk about. We discussed this earlier also. The market sensitivity to such events have waned over the past few weeks. If you look at these numbers from in March, the number of days when the WTI was up 3%, 12 days, and S&P was down 10% of those days, right? So 83% of time S&P fell, and the average return on those days is negative 0.7. April to June, we had a 12 days when the WTI crude was up more than 3%. S&P is a little less. And look at the daily returns, right? S&P did fell, but instead of falling for like 10 days, fewer days it fell. And the magnitude of the fall was even smaller. So like, yeah, we'll figure it out. This drama keeps happening, been there, seen that. Again, things will be okay. And like the fatigue, like as an individual, I have a fatigue. I like stop tracking whatever DJT is posting or whatever the administration is showing, because it keeps changing it. And then therefore the market is a collective humans, right? Or algos, it's not figured out, whatever. So AI, another one, the AI theme has been enduring, and the outlook. So earnings will start to now pick up from next week. I mean, we had some earnings this week. Next week is when the biggest financials will report. And then I think 2 weeks later, the tech companies will start to report earnings. So buckle up. The portfolio could see a lot more volatility during the earnings season. We're looking at the second quarter. The AI beneficiaries had a great Q2, right? Philadelphia Semiconductor Index, SOXX, or if you look at the Kospi, which is Korean. When you talk about Kospi, maybe there are 4 or 5 companies that drive this index. Right now, all of them are, there's AI-related one. They had a great year, great quarter, right? But second quarter is where we have to see the expectations are high in terms of their earnings profile or the earnings growth, especially the tech and energy sectors are expected to contribute 80% of the growth. 23% is we're looking at overall S&P year-to-year growth. Now look at this. Energy companies or the energy sector EPS is growth expectation is 122% year over year. Next is the tech with 63%. Overall, we're looking at 23% growth in EPS is what the analysts are projecting. And I'm assuming the pricing is already accounting for that, and we don't get it. That won't be good. The key caveat is with such elevated expectations, like what happened with Samsung, meeting a forecast may not be enough. There's a lot of growth is already being priced in. And I think, was it last week or a week before that, somebody brought up our Schiller PE. We are currently looking at Schiller PE is around 41. That's the second highest number in the history. I think the highest was around 44 during 2000. So a lot of from a valuation perspective, lot of pricing. I mean, lot of a huge growth is being priced in. So got a time to be a little careful when we have such an high expectations from the companies that we want. Not sometimes it might become difficult to exceed these expectations. Now we're looking at 23% overall, energy 122%, and tech is 3% in earnings growth. Revenue growth 34%. I don't think we'll have an issue in the revenue growth. I'm more concerned on the EPS side because we're doing a lot of investments as well, especially on the tech side, right? All the capex and all that. So I don't know if 23% will be able to meet or not. Even if we meet, I think the stock will still fall down. We have to really, really exceed it. So that's the beauty. So 2026, better diversification would have paid in 2026. If you look at emerging market stocks are up 24% in 2026. Small caps, right? 23%. It's the time for the small caps again. IWM, right? Mid cap 17%. Value stocks, right? 16%. International VX US is 14%. SPY is 10%. Max 7 is negative 2.5%. Like I said, it is actually dragging down the whole SPY stuff so far at the end of June, but who knows? One thing which I found interesting in this one, I found a new ticker, IEMG. Right? And I looked at IEMG because I've been over many years for my emerging markets exposure, I've been trading EEM. And IEMG is much cheaper when it comes to the expense ratio. And it has got exactly the same holdings as EEM. It is from the same issuer, iShares, but it's much cheaper. Does anyone own IEMG? What's the catch here? One thing which I found was from an options perspective, the bid-ask spread is wider in IEMG as compared to EEM, but the difference in the expense ratio, I mean, that's something.
So it's exposed to the global AI semiconductor powerhouses. Right. So Taiwan Semiconductor, Samsung Electronics. So
Yeah,
people
but
are trying to get export besides the US AI and semi stocks, investors in USA want exposure to these names outside. So they've been buying EWY or AIQ or some form of ETF which actually has the ways to get inside those markets and buy.
now if you look at it, this is what, where's the expense ratio? Stock profile. This is what attracted me. 0.09%. It is like a Vanguard types expense ratio.
Maybe they don't trade so often, they just buy and hold.
No,
Because
man,
but
no.
when
Then I looked
you
at it.
buy any stock in the abroad, supposing you're a hedge fund station in USA, your expense ratio for stuff outside is going to be much higher. Why? Because it costs more for them to buy trade.
Whereas EEM is 0.72. Now I'm seriously thinking, because I have EEM in my retirement account. Anyway, I don't trade much on retirement account. I should just dump that, and why not switch to
Not diversified enough.
no, but when I'm comparing both, it's the same case, right? The case that you are making is, hey, don't own these because they're not diversified enough. But I want to own EEM, and I have been owning EEM for many years. Now I'm thinking, why not just switch to IEMG? Give me a case of not doing it because it's got the same holdings.
It's just the same things you pointed out a minute ago, which is basically while I was focused on the AI trades, I lost sight of the fact that all the small cap, mid cap, value slice, they all were moving up. Right? So that's what happens. The market is always rotating money from one thing to the other. So you might hold a less diversified and only focused on AI portion of the emerging markets.
Yeah, but I do want to hold as my ex-US exposure. Yeah, TSM I already own in individual. I own individual is Alibaba, but then it's only 1.68%. So overexposure will be only on TSM, which is a great company to own anyway. But I got a lot of other emerging market exposure. So probably what I will do is to switch. Then I looked at the option side, right? Those who trade options, have you seen or have you noticed how wide the bid-ask spread has become on all the straight street ETFs? I'm like crazy. I've been trading these State Street ETFs for since almost 10 years or 9 years, ever since I started dabbling on an option side. Now, if you look at the bid-ask spread on many of those State Street ETFs like XLK, these all the X's, they're crazily wide.
Has the volume gone down? Or
No, the volume is still high. They're still like they trade 10 on the stock side. There's like a 10 million volume, but on an option side, they're still very wide bid-ask spread.
Right, so the options volume, I mean, because otherwise, why would bid-ask spread go different, right? The only reason is it's trading less. That's why the bid spread widens, because it's dealer market. In dealer markets, the spread accounts for the profit the dealer wants to grab. And so, yeah.
Okay, right now it is off market, so I can't even tell anything. But these used to be my staple tickers, always to trade. And now if you look at it, I mean, there are huge open interests. And I don't think that the volume has suddenly decreased by a lot when what it used to be, let's say 3 or 4 years ago. It is maybe this year I started to notice all these my favorite X tickers for just regular income generation. I'm like, dude, that have become crazily wide. Anyway,
You find rival ETFs that you could have less bid-ask spread.
yeah, but there are not much.
Like XLK, I'm sure has another one. Like it's in the Vanguard world, VTG or something like that.
Yeah, I mean, for XLK, I'll just use QQQ. Right?
Well,
But let's say for XLF or to do, I found ITB, but that's more from the constituents of it rather than XHB. Well, let's say XLU, etc. I don't know. Something which has changed over the last few years. A lot of these have become much wider bid-ask spread. All right. Yeah, I just did this one. I hate. Is it a sign of a peak? So Terry Smith, the chief investment officer / founder / owner of a Fundsmith, is a fund manager based out of the UK. Those who are value investors probably would have read about it. I read his book called Investing for Growth, a great book. I read it maybe 3 years ago. And he's been like the last bastion of value investor. He's got these 3 principles: buy good companies, do not overpay, and do nothing, right? But in the recent half-yearly letter that he sent out 4 days ago, that was like shock to many of the followers of Terry Smith, right? For the first time, he turned over his portfolio to the tune of 51%. I mean, it was interesting to go through the whole letter. So we don't have a time to go through whole, so I just pulled in some of the information. If you look at its previous letters, he used to pride in terms of low portfolio turnover ratio, means low tax implications and all that stuff. But in this half yearly, they turned it over the portfolio 51% time. Purely value-based investor want to buy good businesses and wait for prices to correct, right? But then he came and said, buy and hold strategy can only work if you're not subject to flows, which is true. If you are a fund manager and you do not have a control on the funds in your fund, it is very difficult to do what exactly you want to do. That is why as a retail investor, as a DIY investor, we are in a much better position than the poor fund managers who don't have a control on a lot of stuff. We have a control on when the money comes in, when we want to take it out. We have a control on, I want to invest 50% in one particular stock because I think it's a great business. These fund manager, poor fund manager, even if they identify a great business, they cannot invest 50% of the client money in that particular stock. They have to bound by the regulations, which will prohibit such concentration, right? Even though you know that it's going to be next Google or whatever, or Nvidia. These poor fund managers have no control on the time horizon. They are bound by year-over-year comparison with the rest of their peers. You and I, we can have a time horizon for 5 year, 10 year. Nobody asks, nobody questions us, right? I can take a much longer view point, and then these fund managers, right? So actually, it's like, to me, it will be interesting to see his 13F when it comes out in terms of how much assets they have lost. And now he says, we will take more account of momentum, both fundamental and share price in our investment decisions. This is very unlike of Terry Smith. To me, it seems like that somebody had forced these words, extracted these words out of him against his wishes. To me, look like somebody else might have written this and say, Terry, we have to do this, otherwise we have to close down the fund. We will be much less willing to deploy the time-honored technique of buying quality companies when they hit a glitch. This was used to good effect by Warren Buffett because he has got a permanent capital, right? That's why there's a huge importance of having a permanent capital, which I don't think we pay much attention to, but having a permanence of capital helps you to execute a strategy. So Terry Smith, he says, during 6 months ended 30th June, we executed a series of trades to change their strategy to suit the current and the expected market conditions. When did the great investor change the strategy to suit the market? Shouldn't we be doing the other way around? Shouldn't the market we make use of the market to suit our objectives? Right? So they bought stakes in AppLovin, Givernova, Legrand, MasterCard, Netflix, blah, 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 sold all of these companies. Right? I don't want to comment on, hey, these companies good or bad businesses, but what surprised me was that Terry Smith has finally caved in. This reminds me of Stan Druckenmiller. You should go and listen to his interview of the $6 billion bet that Stan Druckenmiller took. And he said that he missed the market up by maybe a few hours.
Yeah,
And
so I guess there will come a time, which is the March of 2000 that you're referring to with respect to Druckenmiller. But the question is, are we in 95, 99, or
that's
90?
exactly the case. I mean,
And
that's $1 million question.
it
Nobody
was-
knows.
Well, if you look at the price series between 95 to 2001, there were many drawdowns of up to 20%, up to.
Yeah.
And over here, in the last 24 months, the max drawdown I've seen, because I document chart these way, is like 12%. From June 5 to last week, it was 12%. Now it's down to 7% max drawdown. So I don't see that. So essentially, all dips are being bought and ferociously. Just last week, I mean, 2 days ago, look at the Yahoo Finance article on this aspect. That basically, the ETF people have to create new shares. By the way, do you guys know that? So they have had to create new shares on SOX. Given that, it's a signal the institutional crowd is still wanting to chomp at that.
I don't know where it's going to go, but
I'll forward that link. Yeah.
just if you can put that in. But this reminds me that, and I don't know. The other thing which I noticed was Bank of America. After resisting for many quarters of providing credit financing to OpenAI, Bank of America caved in. So they decided to extend $520 million credit line to OpenAI. This is the ultimate violation of Brian Moynihan's responsible growth mantra. Right? the reason why they have not been doing it over the past many quarters was, hey, they don't think OpenAI is that great, doesn't qualify their criteria of providing credit in a responsible fashion, means to the business in which they have a good, they can make sense of that. Yeah, they'll be able to get a decent, the business will survive and all that. So whatever their criteria is, and I don't want to know what the criteria is. The fact that they're caved in because everyone else of their competitor is making money, and they're like, to hell with our criteria, to hell with our responsible growth, let's get in and extend the credit line. It's just like we investors have a FOMO of how long can you wait and see the stock going up and up, and some point of time, dude, I'm gonna buy this right now. Enough. And now that these institutions also have their FOMO.
No, so actually, in a way, institutions have more need for FOMO, or basically they need to hug so-called benchmark because they are evaluated. You are not.
Yeah.
So,
So
so FOMO from an individual investor, I don't really bother about. I discount that if I'm in a cocktail party and people chattering about that's not important. More important is what BOFA does.
so now, and again, right, this is just um like all other players. Why some of these companies will come and give the higher price targets to all Elon Musk companies? Because they want to have a relationship with Elon Musk. They know that you don't want to go against Elon Musk. So, and now while BOFA is doing this, Bank of America is extending the credit line because they want to be in the same room when they're talking about IPO. Right? They want Merrill Lynch to be on the same table when they're selecting the lead manager for the OpenAI IPO, right?
Yeah, they made
And
$50 million for the space.
it's a lot of relationship building, right? And they're like, okay, Brian, shut the F up, forget about responsible growth. We need to get in. And sometimes these things may point us to the fact that, hey, when everyone is basically it's trying to get in because it might be a sign of a top. I don't know. Right? But that was another, to me, it occurred like another evidence of the last holdouts are now caving in. Who else is left? Of course, we saw another two, like SpaceX IPO at $2 trillion market cap. And now I think now the quiet period is over. Now we are seeing Wall Street firms coming with the targets. The targets are anywhere between $300 up to $400 on SpaceX. You can create whatever targets you want to, right? You'll have to imagine the future, and your imagination could be much, much, much wilder than my imagination is. So you can come with any target. Everyone is basically kissing Elon's ring and showing all those high targets or price targets. I have nothing to do with SpaceX. I just want to let them go through a few quarters and show me the business.
So Morningstar analysts have a sell target on SpaceX with a target of $62.
These guys are on. Morningstar is not in a business of investment banking.
Well, anyway.
All other these banks are probably, hey, want to get slice of either the investment banking or the credit side with Elon. All right, upcoming earnings. We got earnings season kicking off. We'll start with financials. Citi, Goldman Sachs, JP Morgan, Bank of America. More important for me would be to keep an eye on ASML and TSMC. What others you guys are watching?
I thought they've already reported last week, no?
No, TSMC reports the end of a month revenue number. They report it every month. ASML does not, but both of them are going to report the formal earnings next week.
Cool.
What do you feel about upcoming bank earnings, up or down? I think the bank should do better in terms of earnings because of all these IPOs. That's like collectively. Now, individual banks, I have no idea how each of the bank will do, but the investment banking arm of a lot of these banks they should, those are a higher value, higher margin businesses, those should do well because the capital markets have done well. Right? The regular traditional banks that depend on loans, etc., that may little bit constrained because of the higher oil prices and the consumers pulling, not, or I would say consumer may not be willing to take on additional loans to fund purchases, etc. That might weigh a little heavy on the mom and pop banks, the traditional banks. But when you're looking at these numbers, all of them have market operations. So, and financials overall still considered as a little bit on the value side. So we'll see how the stock market react. That is anybody's guess. How about Netflix? Netflix looks cheap, but the question is it a falling knife because they're finding it very difficult to grow their user base anymore. I mean, they tried to set expectations of market a few quarters ago, saying don't look at a subscriber growth. I think some point of time they will stop reporting it because they say, hey, that's not how you should measure it. But this week they announced going into live TV. So they've been trying to do a lot of stuff to see what sticks, right? Earlier, just movies and the shows, they moved on to games, podcasts, live TV, try to figure out how they can continue to grow. So looks to be pretty cheap if you look at NFLX. What I'm doubtful is when I say cheap means the stock price has like fallen a lot. It's 43% down in a year. Or now this we're comparing with 2021. So $73. Pranav, remind me of similar situation 2008. Yeah, these all are like, they're all a hand in glove. If you have companies will kowtow to what Elon Musk is saying, all the research agencies. So you got to do your own homework. Okay, buys and sells this week for me, none. And again, I just share it from a transparent, just to be transparent in terms of what I buy and sell. And then at the end of a month, you'll get to know my top 15 holdings. But you shouldn't do what I do. You should figure out what your own game is. But no stocks bought, no stocks sold.
But you're the guru.
This
You're
week.
the stock guru.
Sorry?
You're the stock guru, so people are listening to you.
No. That's the worst mistake we can do, is to try to follow someone. Right. Okay, last topic. OpenAI. I might seem a little more in a bearish tone than usual, but what can I do? I'm looking at so many things and hey, my job is to bring these things in front of you so you can make your decision, and I can make my decision based on what I see here. So let me sip some water and then we'll get into why OpenAI AI could be on a thin ice or ice cube that is melting fast.
Yeah,
Anything else?
one firm in the space, right? I mean, they don't have anything, like you say, the word moat. I mean, there are so many vendors of models now. When this started 2 years ago, this is the thing about working in the high tech world and having any business in it. Like markets are change underneath your foot every every few months. So your leadership 6 months ago is no longer leadership.
Yeah. Bob is asking, everything looks overvalued. Do we have any opportunities in the market? Yeah, I mean, NVIDIA is still cheaper, but that doesn't mean that market will not punish it if everything else goes down. Right? To me, NVIDIA looks cheaper. It's cheaper than market. But if AI story fizzles out, lot of the I'm saying cheaper than the market based on their forward growth estimates. But if AI story we start to see a crack in AI story, all those forward estimates will come down and suddenly will start to look expensive. Right? So that's the case. Yeah, Rajiv says buy those on a low peg. Yeah, but it's all estimate of the growth. And these analysts will just flip the moment they realize and bring down the estimates.
Actually, they don't. That's been the historical record. They are very late, like several months, and the stock price is the only and the leading indicator of trouble ahead.
All right, so let's talk about this. Open AI is on thin ice. Again, this is basically a summary of an interview that I heard on a podcast. Then I
Wow.
went back and got that.
You get a summary as a picture. You
No,
can
I'll go through the content. Picture is basically, yeah, I mean, so it's based on a few bigger categories. One is the whole financial burn versus the revenue. Number two is they're struggling to monetize it. Number three is they have a competitive squeeze coming on. Four is IPO that pushed out, and now they're looking for a government bailout strategy. So basically, these are 4 or 5 big categories under which we're gonna evaluate what's happening with open AI. Okay, this is what the author says. That there is a author Sebastian Malaby. It says there is a 50% chance that OpenAI could run out of money by next summer. Again, I don't pay too much attention to the timelines, etc., because he doesn't have a crystal ball either, right? He's also human. He has his own biases, and maybe he has his own motives to say what he's saying. But evaluate in terms of is it directionally, does it seem to be a okay or not, right? So these are the comments. There are structural flaws in OpenAI business model, right? Number one, an unsustainable burn rate and weak monetization, right? Last year, OpenAI spent $3.4 billion, generating only $1.3 billion in revenue, resulting in $2.1 billion operating loss. I think it must be a quarter. While the company has 900 million consumers, only 5% of these retail users actually pay for the product. Most of them want to use free product. Furthermore, the user base is concentrated in countries like India and Brazil. US is the second one. Most users are in India. US is second. Then third is Brazil, Indonesia. So the consumers are not in the countries which are known for having a higher purchasing power, right? Except US, or I would say North America. Right? All other are developing countries with a lower purchasing power. And the moment you try to charge them, well, they'll move on to, okay, let me now find out, maybe I'll go to some Chinese model. Right? So that's and only in US, they have a consumer who has more capacity to pay. Whether they have a propensity to pay or not, I don't know, but at least they have a capacity to pay. So only 5% of the retail users actually pay, and given the demographic and the geographical concentration of the users, they don't have much lever to actually have them pay for it. Third is they have spent so much money, time, and attention of the teams and the management on trying out and throwing a lot of spaghetti on the wall to see which sticks. Right? So the OpenAI graveyard is filled with some of those products or initiatives that they brought in front of the market. Market got excited for a time, and then we didn't hear anything about that. One is Sora. Right? In 2024, they stunned the world with a Sora and its photorealistic text to video generation model. Right? That was the first one. Gemini came much later with their products. But then, and they also had signed a deal with the Disney, which later on then they retracted. Now in April 26, 2026, they've discontinued Sora. The deal with Disney got annulled. They discontinued Sora as well. So expensive mistake. First part is Stargate mega factories. Remember that $500 billion of a Stargate project that President and Sam Altman and Masayoshi Son and Larry Ellison, they all were in the White House, in Oval Office, signed the big Stargate deal. And OpenAI will be, building all these data centers. Nothing happened. Yeah. DJT tweeted about it, posted about it, got some brownie points, but underneath, in actuality, nothing has happened. So, first of all, company canceled a planned 600 megawatt expansion at Texas, paused their international expansion, and now they're saying, you know what? We don't want to build these first-party data centers. Maybe we'll just lease the compute from Microsoft and Oracles of the world. Switch their model from building it to leasing it. Third one was they talked about a web browser, right? Some time ago. What happened to that? Now July 2026, they announced that they're deprecating the standalone browser, right? So it didn't even do much. I never used the Atlas browser. And now they're just saying, okay, what? We're deprecating it.
I've used the
First-party robotics hardware. Sorry?
So there's a browser called Comet from Perplexity.
Yeah, Perplexity has Comet.
I use Comet.
Yeah. So, but they also had something called Atlas. And now they shut it down. First-party robotics hardware. In its early days, they had highly publicized dedicated robotics team. And the plan was to build a human-like robotic hand, which can basically have all the dexterity what a human hand had. And in 2021, dissolved this whole team, right? And hey, we will just basically partner with other teams. ChatGPT plugins announced as an App Store moment for AI. And now they officially deprecated it on June. Agent Builder Eval platform, they all got deprecated. NSFW or adult mode in ChatGPT, right? In late 2025, he spoke saying, hey, we could have a text-only adult mode or erotica mode on ChatGPT. People who are verified with their age verified, they could have a discussion with ChatGPT, more of a sexual content in nature and all that stuff. Now that has also been officially delayed because of all the protests, and I think from an investor side pushback and the employee pushback, that also shelved. Instant checkout for shopping at 2025 ambitious native e-commerce tool called Instant Checkout, right? They had a partnership with Stripe. Last I heard was Walmart and Shopify. They figured out that doesn't really, gelling with the consumers just yet. The inventory is not updated. Consumer is not willing to shop over there. Consumers still want to go back to Walmart.com or the end merchant website.com and shop over there. So they have quietly scaled back and they've abandoned the in-chat checkout. Hardware product from Johnny Ive. They bought Johnny Ive company for some $7 billion $6.4 billion. So that we can build a screenless consumer application hardware. And it kept the market guessing what's going to be. It's going to be a pendant. It's going to be a pin. It's going to be glasses. What are they going to do, right? The project has been delayed till early 2027. We don't know what they're going to bring up with. So a lot of these expensive side projects that OpenAI has done, while their competitors continue to focus on few things that actually make money for them. We'll get to those competitors, right? Which is like Anthropic. Anthropic is squeezing them on the enterprise side. It's laser focused on enterprise customer who are actually willing to pay. we have been spoiled by Google and Facebook saying we don't have to pay for anything, right? But enterprises have been paying up for services. So while OpenAI went the retail way and haven't still figured out how to make money because they don't have anything else, Anthropic went on the enterprise way, who have a willingness and capacity to pay. And if you look at the Anthropic numbers, they're mind-boggling. Right? We haven't seen the latest number earlier part of this year, right? They mentioned that like 80 times as compared to previous year. And this time they maybe, I think they're rumored to maybe do $200 billion, $100 billion, and maybe double it the next year. It's like crazy. On the retail side, Google has been able to do a better job because they have a lot of distribution for retails, right? OpenAI only had a chat. And then, of course, they came up with all these expensive side projects. None of them worked. Google AI quietly have been building their capabilities on Gemini and now integrating with all those applications that you and I interact on daily basis as a retail consumers. Google has, Alphabet has that distribution to infuse and sell or have these AIs, make use of these AI models and make money. Even if this AI might be a loss leader, they make money through these other distribution channels, right? So they're getting squeezed on both sides, Anthropic on the enterprise side and the Google on the retail side, right? And now the AI tech is becoming commodity. Now we heard about, now Meta is coming back and saying, hey, you know what? We're going to also build our own model. And then, not to mention the whole onslaught from a lot of Chinese models. So at the end of the day, this is becoming a kind of a commodity, which we talked about it, that in longer term, this will become commodity. We won't even notice which AI is being used underneath, like any other technology. So still are trying to figure out how to make money. In the meantime, you need cash to burn so that you can continue to build these things. What the author described it, they use the playbook, which is like typical of Silicon Valley: fake it till you make it, and do all smoke and mirror funding gambits. So they announced historic $122 billion round of funding in March, with much fanfare. It's like, yay, OpenAI is now funded well. So all the concerns around them not being financially viable business, you can put that aside because they got a lot of money. But if you double click on it, there are a lot of encumbrances around this $122 billion. Out of this $122 billion, only $25 billion is available for you to spend, right? All other have one or the other preconditions for it. For example, Amazon made a $50 billion commitment. Only $15 billion is liquid, less than 1/3. $35 billion is conditional and can be drawn only if OpenAI files for IPO and or it achieves certain internal technological milestones like AJ, etc. So you're not going to get access to that remaining $35 billion. SoftBank had $30 billion commitment, which is like $10 billion at close, and the remaining $20 billion is quarterly tranches. NVIDIA had a $30 billion commitment, but it's all compute credits, no cash. Like the whole circular financing that we've been talking about for many quarters, right? There's no cash coming here. You buy the compute from NVIDIA, right? The traditional cash, which is you raise from banks and other I would say institutional capital like DE Shaw, A16Z, which is a VC firm, T. Rowe Price, Microsoft. It includes it also includes $3 billion from retail channels like ARK Invest ETFs. So that's the $12 billion is that cash that they got. Okay. So all these are tied to various preconditions. There are critical terms, right? The infrastructure reinvestment mandate, right? Amazon is telling them, yeah, we'll give you $50 billion, but then you have to commit to spend $100 billion over the next 8 years. Corporate restructuring clause is there. Some of the investments are tied so that OpenAI can complete its plan from becoming a capped profit model into a traditional Delaware PBC. Right? You have to do that corporate conversion. And if you go back in the history, there's a lot of around, is it a non-profit, is it a profit? They switch from when they switch from non-profit to profit, what are the tax implications and all that stuff, right? And Elon has been talking a lot about that anyway. And third is the IPO pressure cooker. Because OpenAI projected to burn $65 billion over the course of 2026, they need money. And they wanted to do IPO in Q4 2026, but now they pushed it out. What are the reasons? If you need money, Space has gone IPO, raised billions of dollars at such an expensive valuation. Why are you pushing your IPO out? The author claims that the concern that it's pushing it out is if you have to go with your IPO, you'll have to open your books in front of all the Wall Street investors. It says it is in the same situation like what WeWork was. WeWork was a great business with a rosy future as long as it was in the venture capital phase, right? As long as it was funded by SoftBank. The moment they try to raise money from public market, institutional investor, public investor got access to their books. And when they looked at the books, they're like, what a crap. Right? This is not a tech company. This is an unsustainable retail or unsustainable real estate business. And they say, we're not touching this from a 10-foot pole. And it never IPO'd. And then, and those investment bankers were not even willing to buy the stock at it. They were willing to dump it onto retail investors. So the author claims that they're pushing their IPO so that they can clean up the house, because if they open up their books to the investor right now, they may not even be able to go IPO. So right now it's on a trap. They need money, but if they go through the public route, then they're really cooked. So what else can you do? Let's go to the government and tell them, why didn't you take like 5% of my stake? Let's offer government a 5% of a stake. Now, what you do by doing that is, hey, you're going to get government on your side. Like government has been telling other, let's say, companies like Apple, hey, buy some chips from Intel. Government will become your investment banker. Howard Lutnick will call up the companies and say, use OpenAI, right? That will give you enough time to clean up your house. And so author claims that's why he's looking for a government bailout, right? Because, or if you go to the public, or if you go back to the venture capital market, you'll have to go through a down round, which will be very bad for employee morale. You can't go IPO because your books are not in a shape in which you would want to, your house is so messy, you don't want to let public market investors come and peek into your house. So you don't want to open up the IPO door right now. You pushed it out. And meantime, trying to figure out, okay, where else can I get money on? Okay, let's give a government a 5% stake. If government owns it, it will become too big to fail. Like, I understand why government invested in Intel. We don't have any chip manufacturing capability in US. But OpenAI, why do we need OpenAI? We got Anthropic, we got Perplexity, right? It's not that OpenAI is strategically important for US. The survival of OpenAI is not strategically important. If OpenAI dies, there are other companies who are willing to replace. Now Meta is willing to replace. Meta is coming into this business. We got a Gemini in this business. Google, we got Anthropic in this. So I don't know if this will even succeed. Right? Why would government want to choose a win? I mean, if the government does pick up a stake in this, that will be like completely anti-capitalism, because then government is actually choosing a winner among these AI providers, right? The foundation model providers. Government should let market decide who the winner is. And if market had decided that we don't want anything to do with an open AI, or let open AI die, let open AI die. Who cares? So even though they made great technological progress, but this whole financial foundation is on a very, very shaky ground. Now, given the fact they've raised so much of you can't go to the venture capital because they say we don't see a returns. I'm not going to give you the same valuation. You can't do IPO. You can't. Government has not yet taken a stake on it, so now they're raising, even though the balance sheet is already very weak. Go back to the debt market and continue to raise funds from a debt market, which puts the company even in more precarious situation. Right? So I think Rajiv was saying, right, they don't see any use of OpenAI in their corporate world. Maybe he's not alone. If that's the case, how this business is ever going to make money?
What I've seen in my current place is it's amazing that they've actually convinced the CTO and all, and given them very good presentation materials to show the rest of the company over, say, 16 sessions how to use the technology. So they've become entrenched. But the key question, as you were pointing out, is how are they monetizing? I don't think so, because last few weeks our corporation is actually trying to measure the cost. So
Yeah.
cost measurement has come into focus in the last 1 month or so.
And you're not alone. I was talking to some of my other friends, and they say their boss is now telling that your usage of AI tokens is now being capped. That gone are the
I
days
never heard
when
that
they were
capping it
doing
off.
Yeah,
uncapped.
that's right.
Yeah. Yeah, and Morley says the open AI Codex product is not very far behind. Yeah, I've heard good reviews of Codex. I've heard good reviews of Codex. I haven't used it myself, but I've heard good reviews of Codex. The question is, can you actually make money on that? Right? Only thing that could save OpenAI is OpenAI comes down, US economy would be okay, but the US stock market could crash. And given DJT, right, for whom the barometer of success is the stock market, he may not want the OpenAI to crash the stock market, and then might choose to keep it alive so that everyone else continue to make money. All those friends and families of DJT and all these big investors have the stake in these AI ecosystem, right? And that will be a bigger concern. But for me personally, if any one of these OpenAI die, like any one of these companies die, let it die. That's what capitalism is. If you can't make money, can't figure out how to survive in this, sure, there are other companies that will take its place. And that's what become better. That's why we have seen better and better businesses. Like all the search engines die. When I started, I remember using the Butler, right? Ask Jeeves. Maybe I'm dating myself. Ask Jeeves, Lycos. I've used all those search engines. They're all gone. Google came. And I would say we are much better positioned because of Google. Right? So don't try to save Ask Jeeves of the world. But it was an interesting, and again, what will happen in future, nobody knows, right? But it was in the whole rara game around all the AI stuff, it was good to see a different viewpoint, especially on open AI and how precarious the situation is. Yeah, Morley says the cost of AI will go down in future. I don't know about the cost, but the what they are allowed to charge is probably will also come down. But that's on the open AI stuff. And that did give me a little bit of pause on how I want to view Microsoft. And I might have to go and find out how much is the dependence that Microsoft has on OpenAI as a company. Of course, they have a stake in OpenAI. And then how much of the future projections of revenue growth of Microsoft Azure is coming from OpenAI. And if OpenAI blows up, what happens? Right. So that was the last topic for today. That brings us to the end of our today's regular discussion. Let's see if there are any more comments. Oh, there are too many. So yeah, if I'm not answered, or if you still have a question, feel free to unmute and we can go through that. I'll also open up the breakout room. Apologies to those who were in the breakout room last week. Mistakenly, instead of me leaving the meeting, I ended the meeting, and that ended everyone's. Was it last week or week before that? And then we joined back. Some of us joined back, and we had a very discussion on a very different topics. But I'll make sure I don't. And if we accidentally kicked out of breakout room, just join back. I'll open it again. Hopefully, I won't kill the meeting today. All right, breakout rooms are open. What else we want to talk about? How does this compare to Anthropic? Anthropic revenue numbers, at least in the street that we are hearing, is they're growing like crazy. Right. So, but I don't know in terms of their I think we did hear that Anthropic is in net operating profit, net positive operating profitable, which is great. I don't know if I've heard the same about OpenAI. LLM companies, maybe the banks of 2008, too big to fail. Not really, because LLM companies don't impact. I mean, we are not yet seeing normal mom and pops even be aware of these LLM companies, and it will get impacted by it. The banks were too big to fail because each American's livelihood, not even Americans, even outside, they were tied to the banks. If OpenAI fails tomorrow, 90% of my social group won't even realize what has happened. It's only those tech people or people who are like who focus on markets and what's happening in the markets. They only get to know about these stuff. And of course, the students who've been cheating using these tools, OpenAI tools, they will be impacted. But yeah, I think the rest of the world will be fine. So I don't think, James, that LLM or OpenAI is a bank. It's too big to fail. Some point of it may become it if it seeps into everyday's life. We are far away from there. All right. So forward earnings is a fable. It's always have been trying to peek into the future, right? So there's always some sort of art involved in forward earnings. You're trying to play God. These analysts are trying to play God, and sometimes they are okay, sometimes they are not. Do you also track the analyst for those estimates? I mean, I think Yahoo Finance will have a list of the forward estimates and each of the analysts. You can find them. I guess Oracle will go down the OpenAI. Yes, on Oracle is not even a good business to own. That's why I've stayed away from Oracle. Is their balance sheet is so upside down that I don't want to own Oracle. They had a stupendous revenue growth, but for when it comes to The real free, of course, they've been investing everything, so the real free cash flow has disappeared. But the balance sheet is what is a big concern to me. Right? They've got interest coverage only 4.5x, which is very, very less. Debt to equity is 3.67.
Well, that's very high.
Yeah, it's a very levered business. It became very levered business. That's a concern I have with Oracle, and that's pulling it down. I mean, it is a but there's a difference between hyperscaler and a hyperscaler, right? So I have a concern on its balance sheet.
Debt to equity on Micron is 0.06.
Yeah, Micron has not. I would rather Micron could just issue equity and raise funds.
You know, luck favors sometimes something's just sitting somewhere and nobody looking at it, like Micron and all these memory stocks in the last 1 year. And suddenly they start getting all the attention in the world.
Chintan is talking about ROIC, basically the return on invested capital.
I left another comment later down which talks about ROIC.
Okay. Oh yeah, that's a long comment. Today, Pat Dorsey says, I would argue ROIC is much less useful as a test for does a company have competitive advantage? Because if you don't have capital, your denominator is nothing. It's pretty easy to generate a higher ratio. It's just math. A lot of credit, software company, high returns on capital.
Yeah, it's going to change. It probably has already started changing in the last 6 months, right? Given how much more important the hardware, semiconductors, and equipment and so on have become relative to your software names. So SaaS companies are, in my opinion, going to become even less relevant in the next couple of years. So, we've seen this happen from 1995 to 1999, when basically hardware becomes far more important. So ROIC will become more important.
So I think I looked at one study, not just one, but there are multiple. But what I remembered is Michael Mauboussin's study, again over tracking the stock prices and the multiple of these financial metrics. And what they found was that study found the ROC has the best correlation over a long period of time.
Right, over 100-year period, because America was going through industrial age and mechanical age.
Yeah.
There was a mechanical age also, where machinery was more important. Anyway, go ahead.
So ROI, so should not look into ROIC in isolation. You also have to look into is because there are a lot of companies like which are falling knife will appear great on ROIC. But when you look at an ROIC, you also have to see, yeah, the return on capital is great, but are there opportunities to deploy the capital or not? Let's say your return on capital, you can make 30% return on capital. But if there is no opportunity to deploy the capital because that business is shrinking or dying, then that's a very bad business to invest in. So you have to look at both. Number one opportunities to deploy the capital. Then when you deploy the capital, is that business generating the decent return? Because if any one of them is missing, then it becomes useless. So that's why I don't look at any of these like an individual metric, but these are, I would say, give me a guideline of how the past has happened, but then I have to see, okay, over the historically, they have been able to generate decent return on capital. In the future, is the market growing? Will they be able to deploy the capital, or are they going to take back the capital and just return it to shareholders? Then we will discount the ROIC aspect based on that.
Yeah, makes sense. I think for like SaaS or rather even software companies, I think all these hyperscalers doing all these investments for now means their ROIC is probably low for these few years. But then going ahead, it wouldn't matter because this gets amortized over a long period of time, I guess.
Yeah, and again, if it's a capex, right, then only you're only um, taking an expense on the depreciation because you're amortizing it. Right?
Hmm.
So it's not that if you have spent $60 billion or whatever, $200 billion in capex, everything's gonna show up as your expense immediately.
So it won't show up in ROIC then. It will show up over a period of years.
Yeah, it won't show up. It won't show up in ROIC because it's not gonna impact your accounting um, profit. So ROIC basically will be a net operating profit after tax divided by the amount of capital invested. So your operating profit will only be impacted by the depreciation that you have taken on your capital assets.
Okay,
It's not the whole amount, but only what you're showing as an expense as a depreciation.
got it. Yeah, thanks.
Why don't you
Uh,
look at return on equity and substitute ROE for your
No, the problem with only looking at return, it's not that I'll completely ignore it. The problem with looking only at a return on equity is you might end up in a business with a high return on equity, but highly leveraged that you suddenly one day realize it became bankrupt. It's like going up, I may look great and then it fall off the cliff.
I think that's probably never going to be true. ROE is a very stable measure, and it's so because the way it is calculated is over kind of like more stable things. Like this guy, whatever his name is, who is saying, software companies make a mockery of these measures because the denominator is like minuscule. They don't have any damn thing invested in their, no capital, plant, and equipment in their company, right? Microsoft doesn't have any.
So how does that matter?
So ROIC balloons. ROIC, that's what this
So,
guy is saying, right?
so
He said value creation in society went away from capitalized asset, which was we had in the industrial age when we were building industries like, chemicals and jet engines, and came into the 80s, 90s when software, like you don't have much capitalized assets, you expense the assets, except for people who are not even on the balance income statement. So hiring a bunch of developers writing code, that's expense. He's very right. So now I think we're coming back. So in my opinion, it's a long-term mean reverting series, like 20 years plus. So hardware is in good shape for the next several years.
yeah. So mm, okay. Mm, Irrespective, I mean, I'm not talking about value creation for society. When you talk about if you're putting $1 in, what are you getting out? Right. And you could say that, hey, they're putting only because software companies are capital light, which many of the hyperscalers are not anymore. But assume that, let's look at all the SaaS companies. And if they are capital light business, if they invest in $1 and take out 1.5, as an investor, for me, that's a great stuff as long as they can have the moat. Having a low capital could also be, hey, you don't have, then anyone else can also come and replace it, which is what these Anthropics of the world have done. So
Vivek,
for
basically, invested capital is looking at very kind of, I think, small thing called what's equity claim and in debt claim, which is part of the capital, right? But there are other pieces which could also be considered, like return on assets.
yeah.
So I think you should look at all two or three of
Yeah,
these.
so when I was like, I looked at a few of them in terms of it's like return on asset. I think the other one, which probably I thought maybe I should add more, is a return on total capital employed.
Yeah,
ROCE, not
ROTE,
just ROE, but ROCE.
right? ROC, right.
Yeah, which include your debt as well as equity both.
Mhm.
Uh, so I found maybe if I were to use any additional one instead of using the ROE, I might be more willing to pick up an ROCE. But I've yet to come across a study which says over the longer period of time, what has worked. Like I said, empirical study that I came across was saying ROIC has worked the best. And maybe I should go back and look at the study. I don't remember. It's like maybe a couple of years ago. And I'll see what does it talk about ROC, or is there any other study which tells me I need to see what has worked over many decades.
Is that like 5 years or more?
No, I think the Michael Mauboussin study was much longer. Yeah, it's so that was ROIC, and that's why I picked up on ROIC. ROE, I said, ROI was not too keen because you can always jack up your ROE by having low equity and high debt, but then you could suddenly die one day because you become so fragile by levering up your balance sheet.
But that transition period will be several months or years, right? It can just be overnight.
Yeah, so it should then it should show up in some of the studies, which is a better metric. I am not capable enough to do the study, so if there is any other professor or someone has done the study, I would be willing to look at. But that reminds me, since we talk about study, I have not read through it, but Professor Hendrik Bessenbinder of ASU, Arizona State University, Carey Business School, I guess, has came up with a new research paper. I really love reading his research paper. The last one which I read was which looked at, I think, all 60,000 stocks across, or 40,000 across the whole world over past, I don't know how many decades, and found out only 4% stocks actually have accounted for all the gains. And there is a whole study around why it is, 60% of the stocks can't even beat T-bills and all that stuff. I think now he has come up with another study which is around comparing buy and hold. So I'll be interested to go through it once I get a time. I downloaded it, but I have not yet read it. So that'll be interesting to read. But if you guys come across any study on which is a better indicator over longer period of time, yeah, I'll be willing to look at that and change it. So what is that study? I think I have a PDF. I can attach the PDF if you guys are interested in returns of do nothing portfolio. You want that?
Well, in my experience, do nothing portfolios don't get you anywhere.
I have no idea because I've not read it. Yeah, I just attached that PDF. I just had downloaded it yesterday. I've yet to go through his study. But I saw someone on a Twitter mention, like, okay, oh, Hendrik Betts, he's out with his new study. Okay, let me go and read it at least. So I just downloaded it. Yeah. What else? By the way, I got a new book yesterday, and I just started reading it today morning. The book name is The Making of a Perma Bear by Jeremy Grantham of GMO.
Oh, God. I just read about him. Yeah, I guess what is your comment on Mr. Grantham?
Yeah, so I thought I was reading another book which I started long back, but it's written in a tough English language, which is The Devil Takes the Hindmost. So it's a little more taxing on my brain cells. But this one has been written in a very, I mean, I haven't read only 20,
yeah.
30.
So I don't know if other people on this current audience follow Mr. Grantham, but if you were around between 95 to 2002 investing, then you must certainly have heard of him. Did you guys? You didn't probably.
No,
Yeah,
not
so
me. I only got to hear.
right. So Jeremy Grantham, so there was a guy named Henry Blodgett who was the
Yeah,
big kind of promoter of all these AI stuff. I mean,
He
stocks
was
like
he was a Cathy Wood or Dan Ives.
Dan Ives. Yeah,
Dan
right.
Ives. He was a Dan Ives.
He was just a commentator, by the way. He was not even like a, in the money management industry. He was like one of the media people. But in case, like he had a famous interview against Jeremy Grantham, in around, I think 2000 or something, like when Grantham was saying this is a big bubble which is about to burst. So he was proven very correct, right, Grantham? And in the next 20 years, especially around 2005, I was very respectful of Grantham's forecasts. He has a company called GMO,
Yeah.
Grantham, whatever, Boston based. And his specialty is laying out forecasts for global asset classes, which means very big aggregates over like a 5 year period. And in that, he scored very well. So if you are looking at that level of aggregate forecasts, Vivek, then yeah, that you should go to GMO's website and pull down his free this thing for forecast for the next several years, like emerging markets will do this, etc. But the moment you want to grab more of the sunshine, in my opinion, you can't listen to these guys because they will be proven right after maybe 3 years. And that's what was happening with Grantham. He being between 95 to 2000. All the way, he's going to be a perma bear. You
Yeah.
can't make
So,
decision based on him.
so like Chinda says, a clickbait title. So he does talk about his interviews. So he had given a different title, but his the publisher says no, this won't sell it. So he says I don't like the title because I'm not a perma bear, but it is what it is. So, but and I think he's talked about in his interviews around how difficult it was for him in and this is what I think Terry Smith also is referring to is to survive even if you are right. Jeremy Grantham lost half of his assets because his investors like you're not investing in these top tech internet companies and you're sitting aside and he was like no, this is not a good company to invest in, this is a bubble, it will burst. He said but we lost half of our business because this pulled the money out, and he was proven right. And they say second time, and at least I know he's the only, at least in my knowledge he's the only one who also predicted the 2007 financial or 2008 financial crash. And in 2009, he switched to become a bull. They say we should invest in these companies. But I think he's known for his bearish calls because he got it twice right. But he says it's so difficult because if you are in a money management business, you could still be right and can still become broke. And he says all our customers, they were just firing us left, right, and we lost half of our book in 2000
Yeah,
because
so
we
there are two things happening here. One is the so-called mandate of any money manager, which is like he is given a particular task, like to hug this benchmark. Maybe it's a tech benchmark or oil benchmark. And so if he is not able to even track that close to it, he's going to lose assets. Number two, I think when like you're trying to say that I'm going to give some asset classes which people can invest and sleep, like another person just told me, like she doesn't have the time or mental capacity to follow. Then you go to places like Grantham and ask his advice. But before those things turning point come, like even in 2009 and 2007 8, you have plenty of ways to make far more money by being selectively positioned
yeah.
either on the long side or the short side. So in the short side, I made good hay in year 2008 because I knew fundamentally what was going on underneath that whole financial bubble. So when the bubble bursts, it's abundantly clear. Okay. Until then, you don't listen to these bears.
Yeah. And then there are bears like Michael Burry who's like predicted 25 crashes
Right.
so
So,
far.
yeah.
Anyway,
So did you find by Michael Burry's past 13 Fs, which they must have just ended 6 months ago? He was
yeah,
doing.
yeah, now he'll not file anymore, right? So
Right. So in those, let's go and analyze how much of his forecast came true. Because that's always good to learn from. Like, how correct are these people?
now Michael Burry, I think there was a chart that we plotted when Michael Burry and who is that guy? Robert Kiyosaki, right? Poor dad, rich dad, poor dad, right? They've been like screaming around the world is gonna end. And there was, I think I
Again,
shared such chart somewhere where it says these are the places where Michael Burry says it's gonna crash, and Robert Kiyosaki says it's gonna crash, and the market is up over past many years, like a few 100%. So
It's mainly because, at least I have not followed this real estate guru Kiyosaki, but their domain is basically, I mean, they've left holding the bag with respect to the domain. Real estate is a freaking dead investment as of 2022. Anybody who understands finance, meaning how valuations work, denominator has a R, interest rates, will understand you don't. So what are they going to do? Kiyosaki is going to bleat.
I, I have no idea what Kiyosaki invested.
And
Sometimes it
what I
just shows
found
up on
amazing
my
was
feed.
like a lot of the so-called stock investors of last 10 plus years, they don't understand how uh, like bits move beneath the software system, right? Beneath SaaS, what the heck is going on in terms of bits? How bits and bytes are transmitted, what's data network communications, what's telecom, what's optical, how things are. And I think that's one of the big issues. They don't see the big things that I can see anyway.
All right, anyone else wants to share anything? It's been just a couple of us blabbering about whatever comes into our mind. Would like to hear who else is doing what, anything new, any book you guys are reading. What are you guys focusing on nowadays? Anyone? Dave, let's start with Dave. I'll have to put people on spot. Dave, what have you been doing this week? Come on, Dave. The which how will people like to invest $10,000 this week? If I have $10,000 that I have available to invest, I'll probably pick up given again, I don't think there's any one answer, right? You have to look at what currently you're holding in your portfolio. And but if I were to do it, I'll probably go in SCHD. Because that'll give me a diversification that I need. I don't want to go big on AI related trades, but that's just me. Chandra said Netflix looks good here. I want to own more ETFs.
Yeah, Vivek, SCHD is up 20% year to date. It's only halfway through the year, it's up 20% already, and it still pays a over 3% dividend yield.
Yeah, it's yeah. I mean, it hold the good company at that. Not necessarily like the dividend. I would want to own it in my retirement account. But when historically I've seen when the if the market is not doing, overall market doesn't do good, SCST does better. But it did not do anything much in, I think, 2023 or 24. It was just flat. Well, that's okay. I want to own a little more cash flowing companies. JC, what does your charts tells you?
It still looks bullish. I mean, the monthly chart, the price is above every single moving average on the monthly, even the 10 monthly. Even the weekly chart is above every single moving average on the weekly chart, even above the 10 weekly, which is, is right there. So far, I mean, that could change by next Friday, but so far,
So with like
everything looks all
the
right.
S&P or any
The S&P 500, yeah.
S&P 500.
Yeah, on a weekly chart is above every single moving average right now. 10, 20, 50, 200.
There we go. Markets are still bullish, it means.
And in order to get anything bearish, you still have to get through the 10 weekly to begin with, right? You can't get to the 50 without going through the 10 the way it is right now. So therefore, the perma bears, if the perma bears had a rule saying I will never be bearish when the S&P is above the 10 monthly moving average, they'll make a ton of money.
Yeah.
Right?
Yeah.
And if it goes below the 10 monthly, then you can start thinking negatively, which is, to me, the 10 is no big deal. But still, if you just have that one rule, we would not be, people that have been bears for 10 years missing out on all of this.
And coming to this prediction stuff, I heard Tom Lee in one of the interviews, and I was shocked in terms of how precise some of these commentators or researchers or stock market researchers get to when they're trying to predict what future. So this is what Tom Lee had to say. I think I tweeted about it, so I'll just put it up. I don't remember but it was very precise. Oops. Hold on. And I'm like, wow. No. Oh yeah, this one was. So he said July will be strong for the stocks. And 8,000 is like, he says, that's my low estimate for S&P 500, right? 84 to 8,800 is possible. But before that, gonna have a bear market, right? So July won't have a bear market. July will be a stronger market. So it means the bear market is going to come in basically August, September, October, because we're going to have a Santa Claus rally at the end of a year, and we're looking at 8,000 as a minimum. Really,
I mean, he's been right because it's been a very bullish market for a very long time. But it'll be nice to see his post January 2022 when we had a big 20% down to the downfall. I haven't looked to see what he was saying from January 2022 to September 2022, but it'll be interesting to see how a Paramount Bull reacted during a 20% downside, right?
Yeah, but he's not
I
been
don't know
right
though.
on many of his calls, especially on the.
Oh no, forget crypto. I'm just talking S&P only, right? S&P and QQQ, he's been right the last, few years.
But not on IWM. I think it was.
No, just the overall market. I mean,
yeah,
just that the trend is going to be higher in SPX. He was bullish. I don't know.
The other one which I heard this week was Yardeni research. Ed
Yardeni.
Yeah, Yardeni is also like minimum 8,000 for year end.
Yeah,
I guess he's always bullish.
But you're right. Yardeni is a perma bull. I didn't agree with his perma bullishness until 2024.
He's got really great data on his website though, and it's all free. Really good data.
Yeah, he's got nice charts. All right. This tells me there's a match today at 2 p.m. Norway versus England.
Yeah, 2 o'clock.
And Argentina versus, so both are today.
6 o'clock, yeah.
All right, but time to head out, grab something to eat, and then I'll come and watch the match. So today's booked till evening then, I guess. Nothing else to do. All right, guys. It looks like there's nothing else. Jeff said every 4th in July, the markets get hit with a major correction. Wow. How come I heard that saying that July is a strong year? Not from Tom Lee, but I think someone else also said July is a strong year. And again, there's a data is different one. But every 4 years, so 2026.
Sorry, what is the comment again?
No, James, look at the James comment. Like every 4 years, July has got a negative. But what I was referring to, I think I heard some market commentators saying July is generally a strong month. And that was not Tom Lee. Tom Lee also said, but I think some other market commentators also say that July is generally a stronger month.
Yeah, if you go to the Ardeni website, he has the data point for every single month since 1928. And it'll give you like the actual numbers for the last 100 years.
So what is this guy, Tom Lee's justification for this July being strong? Why would it be strong?
I think probably in the interview you might have said something. Mostly will be around earnings expectations.
Yeah, that's what. There you go. I guess earnings expectations have been ratcheted up, and the oil-related kind of alarm, which was sounded like March 1st, it didn't come to pass. So two things happening.
Yeah, so I think mostly around Q2 around earnings. And inflation fears, if the inflation doesn't fare up, we might look at Fed
It's
eventually.
under it's under stock market historical pattern, second to last from that group. The one you're on, second to last, yeah, right there, and just pick the one that's yeah, that one. And then it'll give you, if you go down to the left, right there with all those bars, the third one with all the bars, the green and red bars right there, that one. It'll give you some nights, last 100 years, how does every single month. Putting aside, midterms and all those kind of just basically all the years, right? And then the third one, the blue one, will give you the performance, right? The July is 1.71 average, which is the highest out of all
So
12
that's the
months.
highest. Yeah. So July.
And the lowest is September, minus 1.08 in September. That's the worst. I call that September because it's always very nasty month. And then, of course, you have your average increase per month and average decrease per month above that. I don't care about that. Or number of months up, number of months down. The other red ones. So the only one I really care is the blue one. It just gives you the data point.
That's
So,
what they say, sell in May and go away. Because
yeah.
May is like, does
But
nothing.
July is very strong. July is really strong. You normally, right? But like I said, it doesn't differentiate like every 4 years. For example, there is one that does a study with every 4 years during midterms, which is usually a weak problem area. Only until midterms. When midterms comes up, it gets bullish again. But this is just not. I think James had put in every 4 years, which is different. This is all years.
This is all years. Yeah.
Yeah.
Yeah. I never looked at, like, I've seen Yardeni charts on like Twitter, etc. So I know there's great charts, but I never looked at the website. This seems to be and all this is free.
All of it's free, yeah.
Wow, that's so.
And he's got everything. It's just so much information.
Wow.
Yeah, I'm looking at one of his charts in growth versus value, and the first chart which shows such a big disconnect happening in the US economy between growth and value. So starting from 2010 or 2012, which is the reason I felt I missed that whole party from until 2020. The very first chart was good. I guess that's why your England hedge fund manager, he has to switch to the philosophy because he can
Man,
value.
it's like, to me, when I was reading through it, it was like somebody's, writing for him. It can't be Terry Smith.
Yeah, but
when you get a chance, Vivek, when you get
today, my conclusion is, so I followed the value IVE or the small cap rally in the last couple of months, but I believe it will mean revert back. So in other words, they're not durable, but I'm willing to make my call in this and shut up.
Vivek, can you check out on the bottom left? There's under his charts. There's going to be one that's under. If you scroll down, I'll show you where. Yeah, under. I think it's the financial accounts right above there. U.S. distributional financial accounts above the domestic industry. That one right there. And you see how you look at wealth distribution 1. There's 1 and 2, but look at 1. And this gives you like the latest data of how the wealth distribution is in this country is distributed. And you have basically like how much the top 1% has. You can see the top 1% is 1.4. This is just the households by net. This is the number of households. You want the other one that has the actual
This is the US
This is just to tell you the numbers. Yeah, the other one has the actual value.
Yeah, just don't make your country index to the stock market and you'll get back to right size.
By net
Not very difficult.
These are the word. There's another one, I think is the second one. The second one that gives you the actual dollar and percentages.
Oh, okay, down here.
Yeah. And that just gave you 174 trillion. It breaks it down to like 55 trillion has the top 1%, and then 63 trillion
top
is 90.
1% to 155 trillion.
So about 108 is right there, and then it gives you the 51, and then the 4.3 with the bottom 50% out of the 174 trillion.
The problem is because in the whole inflation environment, those who own assets win. So real estate or stocks, if you don't own assets, it's very difficult to get ahead.
Right, exactly.
And unfortunately, those who start, at the lower strata never have enough to make their both ends meet. So they can never get into have any additional capital available to buy the asset. So it's like bad
But just that number, the
bad
bottom
subject.
50% having 1.4 trillion out of the 174, that's an eye-opening statistic.
Hopefully some Trump account will solve a little bit of it. At least force everyone to become owner of or be forced to participate in the asset wealth creation from the stock market. I don't know, but something has to change. All right, guys, I think I need to maybe spend more time on this RNA website. I never knew there's so many charts out here. So thank you, JC,
Oh, no
for
problem. Now you'll like it. It's good information on all.
for this reference. Yep. Yep. But I'll also spend time with reading through the making of Perma Bear and see what that comes of it. All right, guys, enough our discussion today. Go out and have lunch, and then looks like all evening is booked for soccer matches today. You guys have any favorites who you want to win? Or well, like the US has crashed out, so I don't care. Whoever wins, who cares? We are anyway out. Norway. Mr. Holland. He's been the force. I don't know. It's like, to me, it looks like, I don't know. Can we depend on just him? Holland is Switzerland or Norway? Maybe getting confused. But anyway, I think for me it would be France. But don't bet on whatever the FanDuel and DraftKings of the world. I'll just watch it for fun, not for betting. All right, guys, thank you very much. And we'll talk again next week. We'll see what happens in this week. Doesn't matter. It's just 1 week. We'll get through it. Thanks, guys. Talk to you later. Let me see. Anyone on the breakout rooms, or shall I just kill the meeting? No, none of the breakout rooms are open. So it looks like I can just kill the meeting then. All righty. Thank you.